All right, let's dive into a real Wall Street head-scratcher today. Paychex's first quarter earnings. On the surface, it looked like a classic beat and raise. They beat the profit estimates, and then they raised their forecast for the future. But the way the market reacted, well, it was anything but a celebration, which brings us to the big question.
So here's the mystery we're unpacking. Paychex did exactly what investors usually love to see. They beat expectations, and they told everyone the rest of the year was going to be even better. I mean, that should be a recipe for a stock to pop, right? But it didn't. So what on earth did the market see that wasn't in those headline numbers?
So let's rewind the clock to September 30th, 2025. Paychex drops their results before the market opens, and the management team gets on the phone with analysts right as the opening bell rings. And the market's immediate verdict? Well, it was fast and, frankly, pretty confusing.
By the time the dust settled at the end of the day, the stock was down nearly 1.5%. Now, what's really telling here isn't just the drop itself, it's the volume. We're talking nearly triple the average daily trading volume. So, this wasn't some quiet little drift downwards. No, this was a high-conviction move. Big money was selling. And this is exactly why everyone was so puzzled at first glance. I mean, look at these numbers. Revenue came in right on the money. Exactly what everyone expected. Adjusted earnings per share, that's the number Wall Street really focuses on. It came in a penny ahead. That's a clean beat. But then you see that third line, GAAP EPS. That's the official by-the-book accounting number, and it dropped 10% from a year ago. That right there is our first big clue.
Okay, so this brings us right to the heart of the matter. This growing gap between the story management is telling with their adjusted numbers and the official story told by what we call GAAP, or Generally Accepted Accounting Principles. Now, companies use these adjusted numbers to try and show you the real health of the business by stripping out one-time costs. But sometimes the market just doesn't agree with what gets stripped out.
And wow, this chart just lays out the whole conflict perfectly, doesn't it? Over on the right, you've got management pointing to 5% growth in their favorite metric, adjusted EPS. But on the left, you have the market staring at a 10% decline in the official GAAP earnings. This huge difference is exactly where the bull case and the bear case for Paychex just slammed into each other on earnings day.
So, let's step into management's shoes for a minute. On the earnings call, CEO John Gibson and his team, they were painting a very confident, very optimistic picture for where the company is headed.
Gibson kicked off the call with this absolute bombshell of a statement. 17% revenue growth. That is a massive number, and it was almost all driven by their gigantic acquisition of Paycor. Right away, the tone was set. Forget the noise, this is a growth story. And they had a clear strategy to back it all up. They said, look, we're integrating Paycor and we're actually finding more cost savings, those synergies, than we even planned for. They're seeing this huge opportunity to sell their services to Paycor's 50,000 clients. They're rolling out new AI tools. And then the ultimate sign of confidence, they actually raised their full-year forecast for that adjusted EPS growth to a really strong 9 to 11%. But the market? Yeah, they were listening to a totally different story. While management was painting this beautiful picture of the future, investors were laser-focused on the painful present. Specifically, they were worried about the costs of that huge Paycor deal and what it was doing to the bottom line right now. And right here, you can see the total disconnect. It's like they were speaking different languages. Management was talking revenue growth, future benefits, but the market was fixated on the immediate hit to GAAP profits and one particular cost that was just a massive red flag.
And there it is, interest expense. It shot up by over $58 million compared to the exact same quarter last year. When investors see a line item like that just explode, it puts them on defense immediately, and it almost doesn't matter what the adjusted numbers say.
Now let's be super clear here. This isn't happening because the core business is struggling. Not at all. It's a direct consequence of that big acquisition. Paychex had to take on a ton of debt to buy Paycor, and this interest expense is basically the price tag for doing that deal. And it's the single biggest reason that GAAP EPS number got dragged down by 10%.
So, what do we do with this? How do you make sense of these two completely different stories? Well, that brings us to our final analysis, what we think happens next, and our official rating on the stock.
So, our thinking goes like this. First, you have to admit the short-term problems are real. That interest expense isn't just going to vanish, and there is still cost to integrating a huge company like Paycor. Second, the good stuff, the catalysts. It's all about execution from here. The market needs to see hard proof that this deal is starting to pay off with better margins. Which leads us to our verdict. The stock is basically stuck in a tug-of-war with itself.
And for that reason, we're calling this one Market Perform. The long-term growth story that management is telling, it's totally compelling, and it could absolutely come true. But the short-term margin pressure the market is freaking out about, that's also undeniable. For now, those two forces are just balancing each other out, leaving the stock in neutral.
But what if you think the market is just being way too short-sighted here? Okay, here's a little outrageous but plausible trade idea for you. The whole idea, the thesis, is that the market is punishing the stock for temporary pain while totally ignoring the long-term gain. So the strategy would be to buy call options that don't expire for another 9 to 12 months. That gives the company time to prove the haters wrong. The catalyst you're waiting for is that one earnings report where they finally show those synergies are kicking in and margins are getting better. If that happens, the whole narrative could flip on a dime from a cost story to a growth story, and those options could pay off big time.
And of course, we have to end with this crucial reminder. All of this is for informational purposes. This is not financial advice.